Welcome back. The next corporate on our radar right now is Quess Corp. The company reported their numbers, and this is a company with a quarterly revenue exceeding 4,800 crore, though margins are on the thinner side at about 3.5%. And this quarter, the company's done margins of 3.7%. Now, 70% of their revenues comes in from workforce management, which is general staffing. But they also have three other lines of businesses. It's classified as operating asset management, where the company provides facilities management security services. They also have global technology solutions, where they provide payroll management, HR services, non-voice BPO. And finally, a very small segment of their revenues comes in from product-led business, where they have a company called Foundit, which is a job search platform for blue and white collar jobs. Now we'll invite the management of the company to talk more about their numbers this quarter. The key highlight has been the expansion in the company's revenues, margins, though the revenues have been a bit soft. Guruprasad Srinivasan, the Executive Director and Group CEO of the company, and Mr. Kamal Pal Hoda, the Group CFO of the company, is with us now. Gentlemen, thank you very much for joining in. Mr. Srinivas, first question to you. On your margins, 3.7% margins this quarter, what led to it? And two, can you continue to expand your margins? In Q4, say, can we hit 4%?
Sure. Thank you so much for having on this show. First and foremost, we are delighted to deliver a 24% year-on-year EBITDA growth. This predominantly comes on back of our high margin businesses doing well. GTS delivers a 18% EBITDA margin, and our operating asset maintenance business, where we have done a lot of work in last 4 quarters, is yielding results. So they delivered about 5.2% EBITDA margin. So high margin businesses delivering better result. Most importantly, our investment back into the job portal that we had invested, which is rebranded now as Foundit. Foundit has been doing well, and our burn in terms of the product in itself and the cash burn is reducing quarter after quarter, and Q3 has been the lowest. With that, it is releasing, all of this is releasing back into our strengthening our EBITDA margins across group from
Sir,
where
Mr.
we were last.
Srinivasan, what was the loss it Foundit this quarter? And will Foundit be profitable, EBITDA profitable in Q4, which was your earlier guidance?
So as we had said in past, this year, by plan, we had a plan to burn about 55 crores. Compared to last year, it was 100 crores. So we are half by this year. And between Q2 and Q3 itself, we are further half by size. So from 20 crores in Q2, we have come down to about 10 crores of burn. So Q4 is when we anticipate it to further come down drastically and then stabilize around that.
Just to understand, this 10 crore burn is the EBITDA loss, or is this the cash burn at Foundit, your job search platform?
It is EBITDA and cash burn. It is as per plan that we have.
Okay. Is 10 crore loss in Q3 and 9-month loss would be?
Would be roughly about, we are close to about 50 crores of loss for 9 months.
Okay. And Q4, it'll be EBITDA profitable.
Right. That's right.
And Mr. Srinivasan, sorry I missed that. So 4% margin, EBITDA margin possible in the foreseeable future?
If you look at last year, we came as low as 3.2. That's when we started investing in Foundit. And if you look at now our high margin business, both GTS, Foundit reducing its burn, and OAM coming back to, we are at 3.7. So I think we anticipate to stay at these levels at least by up to this year, and by FY25, of course, by end of FY25 is when we can anticipate to be close to about 4%. So that's the trajectory and plan that we have.
Okay, end of FY25, perhaps 4% is a possibility. That's a lot of detail on the margin picture. Let's talk about just growth itself. Because if I look at individual quarters, and obviously there'll be some seasonality, I completely get that. But Q1, Q2, Q3, so Q3 the rate has slowed down. Just blended top line growth has slowed down to about 8% odd. Though I think on a 9-month basis you're still above 11%. So what are the growth signals telling you across the businesses? If I look at the facilities management side, it's been a little more flattish this time around. So can you give us an idea about just top line growth for the various businesses as you step into the new year?
Sure. I have to go a little detail into business. So, operating asset maintenance, we have done a lot of contract restructuring, which is where our EBITDA has performed much better than the top line. So, when you do such restructuring of contracts, it is bound to release and plus the product focus on productivity and optimization that we have brought into set into the next financial year. So we are in a good launch pad in that business at 5.2% EBITDA where we are today, and enter into a right segment. The coming year, more focus is going to be on sales and the revenue growth for that particular segment. Coming back to workforce, as you know, general staffing is our largest business, where majority of contract runs on a flat fee, and wage inflation adds a lot to the revenue contribution. And in a mix, about 70% comes from wage inflation and 30% comes from the sales acquisition, combination of both. So the acceleration of revenue would be far higher than the acceleration of EBITDA margin in itself. So we'll be sustaining at around 2.6% in that platform across workforce. Coming back to our GTS, we range from a 16 to 18% EBITDA margin, and we have been at the highest at the moment, and more international business mix is coming into our GTS platform. As we step into next year, we have a good annual contract values coming in from domestic contracts. So we'll be in a range of 16 to 18% for GTS as well. So at a combined level, plus product-led business coming out of into a break-even stage, we should be able to sustain anywhere between 3.9 to 4% margin. And you specifically asked me on the segment. For our workforce, the good set of growth is coming in from the manufacturing, BFSI, and retail environment. So this is where the maximum hiring is happening at the moment.
Mr. Hoda, comment on workforce management, right? That's your majority of your revenues. While you are seeing traction, growth in manufacturing, BFSI, retail, the thing is that growth rate over there at about 12% is still slower than what we've seen in the past few quarters. And even if I compare it to your listed peer, TeamLease reported a revenue growth of about 20% plus in the workforce, the general staffing business. So tell us why your growth has moderated in workforce management despite Q3 being seasonally strong, and why it's lower than your peer.
So thanks for the question. As you rightly pointed out, I think the growth has been on these three key sectors, which is BFSI, retail, and industrials. In fact, in industrials, we've made a vertical within workforce management and within general staffing with a clear focus of enhancing headcount, and there from a 5,000 odd headcount, which you used to have a year and a half back, they're right now at around 65,000 plus headcount when it comes to the general staffing business. But yes, within general staffing, there are segments which, and especially IT, ITS, logistics, and FMCG, we have not seen that kind of a growth. And also, end of Q3 is usually end of season in the workforce management business. So there is a bit of a cyclicality there when it comes to closing out the season. But the other three verticals, which is BFSI, retail, and industrials, has continued to add headcount. And cumulatively, we've seen the growth rate for this vertical to be 4% up year on year and 3% up quarter on quarter. On the EBITDA side, on the revenue side and the headcount side, obviously the growth year on year is in double digits, close to around 12%.
And just a little bit more color on the operating asset management business, where again, revenue growth has been a little subdued, 1.5% quarter on quarter, just up 1% on a year-on-year basis. And for the benefit of our viewers, operating asset management business is largely a facilities management business, or where the company provides security solutions, to large companies. So why is it that while your margins have expanded in operating asset management, the revenue growth has been a bit sluggish, Mr. Hoda?
Yeah. So you're right. Revenue, we clocked a 695 crores for the quarter, growth of 1% year on year. Revenue growth saw some challenges due to rationalization of few large contracts, and we were focusing more on margin. We have a very good pipeline for Q4, and we are confident to bounce back as we were doing some focus investment in certain key sectors. There's also a bit of a, margin is also an outcome of a bit of a business mix, which is happening. So some of our high margin businesses within OEM, which is food and telecom, have done better than facility management per se in this particular quarter. But like I said, pipeline for Q3 is promising, and we are expected to bounce back in Q4 as far as the top line growth is concerned.
Okay, all right, gentlemen, we will leave it on that note for today. Thank you very much for giving us more idea about the business trends, and good luck to you for the rest of the fiscal as well. Well, that is Quess Corp. On that note, we do have to take a very, very quick break. We will come back on the other side and get a conversation going on the markets. We will have with us Bhavin Shah of Samiksha Capital.